The wire is staged at $47 million across 3 jurisdictions, and only your signature is missing. Compliance signed off the moment the account was named, and now only the signature remains as formality. You scroll to the bottom of the document and sign, and the wire releases as the screen goes blank. The money moves through Luxembourg, then the Channel Islands, then Singapore. 3 jurisdictions in 14 seconds. By morning, the wire does not exist on any balance sheet that any regulator on Earth can touch. You haven't always been the one who signs. You started where everyone starts, with a checking account. Your first paycheck hits checking at $3,200 after tax, after FICA, after the 401k. You don't know what a 401k is yet. You only know the money is gone before you see it. This is where you hide your money at this level from yourself, quietly. Through the contribution slider, the Marcus High Yield Savings pays 4.5%, and you feel rich watching the interest tick up. The Fidelity 401k holds VTSAX, a fund you've never heard of, and you don't change a thing. You opened a Roth IRA after a TikTok told you to, and you contribute when you remember. Total net worth is $84,000, and you think you are being clever. You think this is a hiding place. You are not hiding from anyone. The IRS sees every dollar, and the custodian reports every contribution. Your money is fully visible, fully reported, fully exposed, yet tax deferred. So the ledger calls it shelter. You start to learn the words: pre-tax, post-tax, capital gains, ordinary income. And each one is a lever. You realize the tax code is not a punishment, but a manual 3,000 pages of instructions. You start reading the manual, highlighting, underlining, and taking notes in the margins like a student again. Most people will never read this. Most pay a CPA once a year and forget what was said. You decide to read it yourself every year, every revision, and every footnote. Because the manual changes slowly. You earn $215,000 a year, have a net worth of $420,000, and the 401k is already maxed. The backdoor Roth is automated, and the Schwab brokerage holds $190,000 in index funds. You see the asymmetry. Earned income is taxed punishingly, while long-term capital gains are taxed gently. You file an LLC for the consulting work. The LLC opens a Mercury account, and you feel something shift. The LLC pays you a salary while the rest is distributed as a K1, and the effective rate drops 4 points. You learn the Augusta rule and rent your own house to your LLC for 14 days a year, tax-free. This is the level where you stop earning money as a paycheck and start structuring it as architecture. You meet a certified financial planner with a $500,000 minimum, and he is polite, but not interested. You are not a client. You are a prospect, and the polite smile is an invoice for next time. You go home and Google what a revocable living trust is, and you read until 2 o'clock in the morning. Your father calls about a bill, and you wire $4,000 from the LLC, not your own account. You log it as a consulting fee. The LLC writes the transfer off, and something quieter than guilt arrives. You stop telling people what you make and what you own, and you learn the second silence. Net worth $420,000. The structure is small, the instinct is set. The next level wants ownership. Net worth $4 million with real estate depreciation, an S-Corp, and your first 1,031 exchange staged. The S-Corp pays you a reasonable salary of $180, and the rest is distributed as profit, untaxed by FICA. You bought your first commercial property, a strip mall in Texas, at $1.8 million, 65% leveraged. Depreciation shelters $52,000 of taxable income annually, and the IRS on paper says you lost money. You learn the phrase swap till you drop. Keep exchanging until you die, and your heirs inherit clean. The capital gains are deferred forever. The tax bill never comes due, and your descendants inherit a clean slate. There is a CPA now who charges $14,000 a year and saves you $80. The math is simple. You stop attending family events because the conversations have become technical and isolated, and you no longer explain. You begin to think of yourself quietly as someone different, then quieter than that, then nothing at all. A college friend messages about a job loss, and you read the message twice and do not reply. 3 days pass. Then you offer a recruiter intro instead of a loan, because lending leaves a paper trail. You tell yourself this is the responsible answer. You are not certain and you move on anyway. You realize you are no longer poor. The fear of bills is gone and a new fear has replaced it. 3. 4 million is enough to live on, but it is not enough to be invisible. Invisibility is next. Net worth is 12 million, and the Revocable Living Trust now owns your home, your brokerage, and your business interests. Probate is impossible. Your name appears on no deed. The trust holds the title, and you hold the trust. You allocate $400,000 to a private credit fund at 11% net locked for 3 years, accredited only. The retail world cannot access this. The wall is the point, and above the wall, the rules differ. You set up a donor-advised fund with $750,000 of appreciated stock, and the deduction lands today. The IRS sees a charitable giver, while your CPA sees a tax arbitrage instrument. Both descriptions are true. A private banker from JP Morgan calls you not a planner, a private banker, and you agree to meet in Aspen. There is no agenda and no pitch, only a fireplace, 3 other guests, and a list you are now on. You begin to understand at this level the money does not hide, the structure does, and you hold nothing. The trust holds the asset, the DAF, the gain, the QOF, the basis, and you hold nothing on paper, yet you hold everything in practice. The structure obeys. The lawyers obey the ledger, obeys, and you sign. The private banker visits twice a year, not at the office, but at yours. The asymmetry has flipped quietly. You stop calling old friends, and you hire someone to remember birthdays. And you discover that calendars are also leverage. You used to think you owned things. Now you understand. Things own you, and structures own the things. Net worth is $58 million, and you change your domicile to Florida, where the state tax savings buy a second home. You set up a grantor retained annuity trust and put $20 million of pre-IPO stock inside it. Projected appreciation of $40 million over 5 years, and estate tax on the transfer to your children zero. Inside an irrevocable life insurance trust. $25 million of coverage pays out estate tax-free to a future generation. Premiums are gifted in. The death benefit lands outside the estate, and the next generation is funded before existing. A family LLC holds the operating businesses, with you owning 1% and the children's trust holding 99%. The IRS calls this aggressive, while your attorney calls it standard. And only one of those descriptions matters in court. No more financial planner. You have a wealth advisor with 6 other clients paid in basis points. You are no longer a prospect. You are a relationship. And the word changes everything, because loyalty becomes billable. You buy a Wyoming home, spend 10 days there a year, and an out-of-state LLC holds the deed. You begin to lose track of where assets technically live. Florida, Wyoming. Delaware, Nevada, the map is a chess set. Geographic ambiguity is the design. The IRS prefers concentration, while you have learned to prefer dispersion at every level. Your spouse asks where the money is, and the answer requires a slide deck. You show one anyway. Your children's inheritance is structured before being asked for, and your descendants live downstream of a paragraph you signed. Net worth, $280 million, and the first call comes from Zurich. You take the meeting in Geneva. The bank has no public website. The minimum is not posted, and the number is told only in person. The number is written on a napkin. You read it and hand it back, and it exists nowhere on paper. A Cook Islands Asset Protection Trust holds the bulk of your liquid wealth, and the jurisdiction recognizes no foreign judgments. A creditor would have to fly to Rarotonga and relitigate locally within a year. Most settle instead. A Cayman Special Purpose Vehicle holds your private equity stakes with the fund itself. Structured as a Singapore VCC, the chain is 6 layers deep. Beneficial ownership is technically required. But the question is, which jurisdiction is asking? You have not been audited in 9. Years because probability is statistical and structure is deliberate. You stop caring. A wallet. Stop driving yourself. And stop doing most things a previous version of you would do. Nobody around you knows what you actually own. Not your friends, not your siblings, sometimes not even your spouse. This does not feel like a problem. It feels like the design since no person holds the entire structure. Your liquid reserves sit in a numbered Geneva account with the number memorized and never written down anywhere. You buy a yacht because the family office advises it. You step aboard once and it stays on as a structure. Net worth $280 million. None lives in your country, yet all of it answers when called. Net worth $1.4 billion. You hire a CIO who used to run a $4 billion endowment. The family office runs everything with 43 people working for it, and no card on staff bears your name. The Dynasty Trust is structured in South Dakota. Perpetual duration, no state tax, no rule against perpetuities forever. The wealth never transfers because legally it never moves. The trust outlives generations, and you become a footnote. Your foundation gives away $80 million a year, and the 5% requirement is met through grants to chosen institutions, the same institutions where your family name sits on the buildings. Philanthropy and naming rights ride the same form. You own a Basquiat that does not live in your home. It sits in a Geneva Freeport vault tax suspended. You have never seen the painting in person. Once a year, a paid photographer documents it for insurance. Wealth is no longer measured in dollars. It is measured in jurisdictions, in generations, and in structures. You stop checking balances because the numbers are too large to mean anything. You check the architecture instead. Your CIO has no office in your building, only an office in another building, and the relationship has inverted. Your descendants will not inherit money, only a machine, and the machine inherits its own future indefinitely. A Manhattan penthouse stands unentered for 2 years, with staff still polishing the floors and forwarding the mail. The wealth has become abstract. It moves without your hand on it and feeds without your eye on it. Net worth undisclosed. Estimated by people who estimate such things at over 11 billion, and the figure is irrelevant. A finance minister of a small European country calls not for investment, but for a view on a yield curve. You give the opinion, the country incorporates it, and a bond auction reprices 6 hours later in your favor. There is no longer a your money, only a structure of 17 entities across 9 jurisdictions held nowhere whole. The whole shape exists only on 3 secure drives. Your attorneys hold pieces. Your CIO holds pieces. None hold all. You hold a deposit at a private facility most presidents do not know exists. It earns no interest, only permission. Your foundation co-funded a World Bank initiative through a Liechtenstein vehicle, and the classification saved $400 million. You have not entered your home in 2 years, the office in 5. Yet your name remains on the door. Inside the office is empty. The chair unworn, the light off, and the structure functions without your presence. You are not in any specific sense anywhere. You are in the architecture, and the architecture holds anyway. The phone rings, but it is not urgent. At this level, nothing is urgent. The trades happen. The transfers settle. You do not answer. The call enters a system that routes the question, and the answer arrives without you. What ultimate financial control costs? Privacy, trust freedom, and the hands of people who once knew your first name. The architecture continues without you. It does not need you to live. It does not need you to die. Somewhere you walk into a glass tower carrying a small bag with $812 in checking. You open your first Bloomberg terminal. The orange characters flicker on, and the spreadsheet looks like a simple cash flow. $812 in checking a 401k starting Friday, and you think this is all about salary. You think you are hiding money in a Roth IRA, and you think the slider is your own clever decision. You don't know yet that the slider is the smallest lever in the longest manual ever written. But you will,